Hi, I'm Destry Dijon with 72 Sold. Wondering about the housing market? Well, the following video will explain it all. It's a complete overview of everything that's happened over the past few years, from before COVID, during COVID, and after. There are easy to understand charts and graphs that really help you understand it, from interest rates and inventory to home sales and home values. Take a look.
I am so excited to do this presentation. Honestly, I looked it over this morning, and what amazing information. And by the way, this is information not just for you to have to know, because it's great to have, it's great to know, but this is information that you can share with your fellow agents in your offices, that you certainly would want to share with your clients, to just show them a picture of what it's been like and why the market is where it is right now, because this is a big why.
Yes. This
is the why this market that we're now in, which is a relatively challenging market, to say the least. Yes, to say the least. This is a relatively challenging market. So we'll get her started. So first of all, let's take a look at the economy. And this is a 10-year growth picture. And Sarah, I'm going to let you present the slide. So tell everybody about this slide.
So what this is the stock market, right? We've seen massive growth, and the top line is showing where we were basically 14 to the start of the pandemic. And that really shows that kind of pivot line of where we were and where we were going, and then COVID. And then you can see kind of the extreme up and down and the volatility that we've had since COVID, a lot of it having to do with some of the things that we're going to be talking about on future slides, but even shows you kind of that trajectory and the speed in which our economy was moving over the last decade. And it's been in this big growth mode, and COVID just sped it up and slowed it down.
Yeah, and you can see the very obvious drop in the stock market right around COVID there. You know, in March 2020, that's obvious. The stock market took a absolutely huge hit. And then when everybody got their arms around it and figured we would get through it, how the stock market picked up. And then recently with the Fed tightening rates, would you say that's primarily why?
A lot of the volatility is on that. Exactly.
So really, when the Fed brings up interest rates, that's for the purpose of slowing down the economy.
Yes.
And obviously, businesses are going to, well, the investors in businesses are going to say, well, the business I'm invested in may not make as much money.
Yes.
In fact, some businesses may not make money at all. And so that's why you see the stock market dropping. The reason I think this slide is also relevant is this is kind of a gauge of consumer confidence.
Yes.
So I watch the market each day just to see where buyers and sellers' heads are. You know, if we have 1,200 point drop about a week and a half ago on a Monday, maybe it was last Monday, you know, that really tells you where people's heads are. So that's one reason to watch the market even if you're not in it, okay?
Exactly.
So unemployment rate. So Sarah, why don't you talk about that?
So in kind of conjunction with that strength of we saw Wall Street was really strong. Now we're looking at employment. We had kind of a decade, of the 2010s where we had a lot of growth, employment increased. It took a while to get there from the Great Recession, and we got to, 3.5% unemployment. And then we know when March hit, that exploded the unemployment. We had a lot of challenge there, and it took basically until July to recover all the jobs lost and get us back down to that rate. So this is really showing the representation of the impact of COVID on our job market.
Yeah, and what's interesting is the unemployment rate, I guess, prior to COVID really is very similar to what it is today, right?
Yes,
so we had just
strong.
a huge immediate spike in unemployment. Obviously, when you close every restaurant in the country and half the retail businesses, right? That's
brutal.
Brutal, right?
It was brutal.
So this was, I would say this is very expected what we're seeing here, correct?
Yes.
Okay, so 12-month percent change consumer price index. This is a biggie because
this hurts.
This hurts. So talk about that, Sarah.
So this is where we've had, and we didn't have a lot of inflation when we had some of the government assistance when the recession hit, because it was such a slow recovery. This recovery was very fast, and our economy is very much a consumer economy. And so when we all had to stay home, we stopped spending on services, we started spending on stuff, and everything got more expensive, and we're living it today. And this just shows why the Fed is kind of saying, we've got to find a way to get control of this, because this is hurting all consumers, and being a consumer economy, if this gets out of control, people just stop spending money because they run out of it.
Yeah, and you can see from the Fed's perspective, when we say the Fed, we mean the Federal Reserve.
Yes.
You can see from the government, from the Fed's perspective, look at the inflation rate going back to '02, and you can see that in '08, it peaked, and then obviously
Tanked.
we know what happened in '08,
Yeah.
and you can see it tanked, and then you can see where it's been cruising along in that 4 or 5% range, and then all of a sudden 8.5%, and then August 8.3, and they were really hoping to bring it down faster.
They were, and that number shocked a lot of people. Some of the impact that we saw with the stock market volatility is because that 8.3 freaked out a lot of people.
Yeah, and I'm sure you know, but the big problem with inflation from the government's perspective is that if wages aren't rising, if people's ability to buy doesn't rise as fast as the cost of the things they buy, then they're losing buying power.
Yes.
And an economy that over time, a consumer base that over time loses buying power, well, a lot of things happen. That group of people have to live less well.
Yes.
And number two, everybody who's in office gets unelected.
Yes.
Those are the two things that
Yes,
happen, right? All the
absolutely.
politicians are out, let's bring somebody else in. So the government doesn't want to see that happen.
No.
People who are in power
Want to stay.
want to stay in power. Exactly. Cardinal rule. Okay, so mortgage rates. Well, I think you guys know what that's going to look like. Sarah, go ahead.
Woo. It's been interesting. And so we see rates were really great pre-pandemic. We were having, 3.5%. We know we talk about it, historic lows, all that. And then what happened when our rates went down to below 3, which nobody ever expected, and don't ever expect to see again, because what happened when with that unemployment, with everything, the Fed was like, how can we enable, consumer confidence and investor confidence? So they started buying. And just in that window, showing from April of 2020 through when they stopped buying at the end of November of 21, they bought a $1.4 billion in mortgage-backed securities, which gave the secondary market investors a lot of confidence. Rates went way low, and we know when money is not quite free, but almost free, people went for it.
Yeah, people went for it. And if you're going to borrow money, you generally need something to buy.
Yes.
Why am I borrowing? Because I want to buy.
Exactly.
And the number one thing people buy with borrowed money is housing.
It's a housing.
Housing. And probably second, I'm guessing, is cars.
Yes.
I would guess. But clearly housing benefits the most from low interest rates.
Absolutely.
And gets hurt the worst from high interest rates. Would that be fair to say?
Real estate really is just very volatile. When mortgage rates move, we feel it. And you can see that on this chart because they stopped buying mortgage-backed securities, which means the rate to get investors to want to buy those had to go up. And every time there was something that scared people in the market, like inflation numbers, they had to kind of make it beneficial for investors to come and invest. And now we're looking at 6.3.
Yeah, 6.3. Okay, so one lesson in economics. Why does the Fed buying mortgage-backed securities, how does that lower interest rates? So the answer is, if you don't know, is these debt instruments are typically fixed rate. So they're fixed rate debt instruments. So what that means, like it's maybe a 5-year note at 4%. So if all of a sudden a lot of people start buying that note, that it might then sell above par. If par is 100 and there's a lot of demand, and the Fed can create demand, you have private demand, you have government demand, then what happens is the price of that instrument might go to 103, 104, 105. That is, investors are paying $105 per $100 debt instrument, okay? So what that does is that lowers the effective yield. If you paid $105 for a debt instrument that pays a fixed return of 4%, you're not getting 4%. You're getting 3-point-some%. So that's how one of the ways that the Fed manipulates the mortgage market is it will buy or it will refuse to buy, and that has the impact on the effective return. Does that make sense?
Yes.
Okay,
Yes.
little lesson in economics.
I like
there.
it. I like it.
So Fed funds and mortgage rate. Go ahead, Sarah.
And so what this is kind of, it's showing, the red line is the same chart that we saw in those interest rates, but now we're looking at what those Fed funds rates and they're lending money at 0.05% or 0.08%. We had over 2 years or nearly 2 years of incredibly, again, cheap money. And so when the Fed started raising those rates, and it shows even, pre-pandemic, it was not this low. They lower it when you have those giant stressors like, a pandemic.
A pandemic, yes.
And so, here
those giant stressors. Right? That was a giant stressor.
Yes, certainly.
We were all wearing masks and eating at home, right?
Yes,
so, totally.
yes.
Go ahead, sorry.
Keeping far.
So the Fed funds rate prior to the pandemic, like 1.5 to 2, is that what that's looking like there?
Yes.
Pretty normal. Then they drop it down to 0.05 to 0.08, basically zero.
Basically
right?
zero.
Basically zero. And now they've pushed it up higher than it was in all that time before. You can see up at 2.33, and it looks like they'll be pushing it up again.
And we'll actually find out later today what they're going to be doing with, kind of how they're looking at the inflation numbers that just came out and other things. There are some expectations that at the end of the year we could hit about 4% there.
That's the predictions, I think, 4%. Yeah.
And that's pretty
which is going to push mortgage rates probably above 7. That's what it would do. If those go to 4, the predictions are that home loan rates would go above 7. And okay. So we'll get to what that might do here in a minute, right? So recession means falling mortgage rates. I think that's pretty clear. Why don't you just talk for a second about this slide? So.
And this just shows and these are mortgage rates during the last 6 recessions, and they did decline. And we do have, information that kind of shows we do see in recessions interest rates go down to try to stimulate the economy,
right.
Make money cheaper. And, and Greg and I were talking about it, where how different is our situation today, we don't know, but it's an easy expectation to say rates when a recession hits, if we're not already in one. I know there's a lot of different dialogue on that. Rates can be expected to go down based on the history.
Yes, and what I was telling Sarah this morning is, even if now I thought a recession was defined as 2 consecutive quarters of a decline in the GDP. Since then, I've read a lot that they're trying to redefine that, since I believe we have had 2 consecutive quarters of falling GDP. So, doesn't necessarily mean we're in a recession, right? So whether we are or whether we're not, I remember back to like 1981, there was room to move rates down, as we'll see, because they peaked at around 18%.
They were very high.
Exactly. But here in 2020, they moved them down about a point to try to juice up the economy, right? Would that be? Yeah.
And it worked.
And it worked. Okay. So mortgage rate history.
And this kind of shows some of that change. It's again, you see the gray bars are recessions, and rates did go down in each of these recessions. But this also shows the speed in which things can change. You can take, like if you're looking in 1981, 15 months to go up, 19 months to come down. And so rates can move as quickly as they move up, they can move down. And, but guessing that and predicting that, it's not something I can do.
So I not only lived through, see that 18.63% there in 1980, 81?
Yeah.
So I not only lived through that, I was in the real estate business through that. So if you think it's tough to sell houses with an interest rate of a little over 6%, try it when the interest rate is over 18%.
3 times higher.
3 times that. In other words, per $100,000 of loan, you are paying over $18,000 a year just in interest per $100,000. So you also note what's interesting is look at the last few years, 4.57, 4.94, 5.89, now it's a little over 6.
Yeah, that's older.
Really, this last few years, 6 is not that bad. It's not that far off of where we've been. It's just perception.
It's perception.
Everybody got so used to the 3% that 6% is like, are you kidding me? This is mortgage robbery. When actually it's not.
That was mortgage robbery
back then. Okay.
Yes.
So I think a big part of the resistance we're seeing right now, buyer resistance, and the number of buyers that are backing out of the market isn't just mortgage rates are making things less affordable. I think a big part of it is perception. Well,
Yes.
I missed the 3%, and no fool goes out and gets a loan at 6%.
Right.
When actually 6% is pretty good historically.
And if you think about it, if it does go to 7, hey, aren't you going to be glad you got that 6%?
That 6%
you know?
loan, there you go.
Exactly.
Okay, so let's now go to home inventory over the years, Sarah.
So this is showing kind of where we've been moving, and we have, over the last decade, have been seeing shrinking available inventory. It's been a common theme. A lot of it has been due to the low rates. A lot of people, when they moved, they kept on, hung on to that other house, kept it as a rental. We had over 8 million units become rentals in the last, in the last decade, and that's single family across the country. And so as we're seeing what's happened, and now you can see how, from 2019, we're at 43% fewer listings than we had then, but it has definitely been creeping up. And again, the speed of change can be daunting.
Yeah.
And we saw in June and July just a massive increase in inventory, and then all of a sudden it stopped.
Yeah.
And now it's putting us in a very different situation, and some people are calling it a seller's strike, because if you have that 3% mortgage rate, and now you're thinking about, between that and the appreciation rate, considering our incredibly low inventory, people are saying, you know what, I'm going to stay put. I'm not going to sell my house. And it is going to put even more pressure on our industry and more pressure on everybody who's within it and, sellers that do need to sell.
Yeah, so this is an important slide and an important comment that Sarah just made, and I'm going to take 30 seconds and make a comment. So first of all, you can see that home inventory is not high now. It's about doubled.
Yes.
Since its low point.
Yes.
But comparatively over the years, anywhere from 900,000 to 1 million units has been pretty normal over the last few years, and you can see it went well above 1 million. You okay?
Yeah, it used to be above 1 million. Basically prior to 15, it was always above 1 million.
Yeah, and this is U.S. National Home Inventory,
Yes.
Homes for sale.
Yes.
And this is existing homes, I think.
Yes.
This is not new homes, this is existing homes. So we're sitting at about half maybe of normal inventory. So inventory's low, which would be a good thing for home sellers, right?
Usually.
Usually. The problem is demand has dropped off precipitously as well.
Yes.
And what Sarah said, and this is the big point, I believe what a lot of people are saying, and sometimes I agree, sometimes I don't, this time I do, I think we're probably going to see a general, well, we're seeing it now, a general slowing down of turnover. Fewer people putting their homes on the market because they don't want to trade from a 3 to a 6% loan when they buy.
Exactly.
And fewer buyers because interest rates are higher.
Yes.
And consequently, home prices will probably at some point stabilize. They're going down in most parts of the country now, but they'll probably stabilize. But everything will churn at a lower level. Now,
Yes.
this is a big point, a practical point for you. Everybody in the 72 sold system, this is our opportunity to shine.
Yes.
With our differentiation home selling program, with our ability to market. And Sarah, you've looked all over the country, and I'm not looking for a compliment, but have you ever seen a real estate organization that knows how to market the way we know how to market?
No.
I think it'd be
No.
clearly,
beautiful.
a conservative statement to say we're far and away, we understand how to market for home sellers, to get our agents indoors better than any firm ever in real estate history. This is where we will shine, and this is where our competition may actually end up, to a large part, going out of business. And but boy, we got to be on our game to shine.
Absolutely.
It isn't just going to happen because we happen to be 72
Right.
sold. We got to be better, we got to be sharper, and we got to continue to make our presentations, our program, and our marketing better and better. Okay, this is a really important slide. So newly listed homes, talk about that, Sarah.
And that is, and we're talking about even, with the new inventory has definitely slowed. And I know there's a lot of colors we're looking at, but the kind of yellowish for 2022, you see that we had a steep decline. We had a sharp increase, when rates went up and of our inventory, and then all of a sudden an unseasonable drop in new listings. As you can see kind of off to the right, it's very typical end of the year. We do see a decline in new listings, and nothing about this year is really matching that. And so there's a lot of, just conversation of where are we going to be at the end of the year if this is where new listings are coming in?
Yeah.
are they, how many fewer are we going to see? Because the number keeps getting smaller and smaller.
So look at this, all of you. I thought this was fascinating. I really didn't realize, I've been in real estate obviously a long time, I didn't realize that the number of new listings, I presume this is the number of new listings month to month here, right? You see the months across the bottom.
Yep, exactly.
So you can see how nationwide the number of new listings, typically most years, in the spring, going into the summer, that's when we see a peak, right?
That's when we see it.
And then typically going into the holidays, that's expected, it drops off. You guys can all see that. All those colored lines, of course, are different years. But look at this year, what Sarah said, and I didn't realize, by the way, over the holidays, I knew it dropped off, but I didn't realize it dropped off that much. That's pretty dramatic, on average. But then what Sarah's saying is it's starting to drop off this year much earlier and much faster. Earlier, faster.
Yes.
So it'll be interesting to see how fast it gets down to that normal December level, which is what, around 300,000.
Yeah, it's way.
And will it go below that? So again,
probably. You kind of follow the potential trajectory there. Probably.
Yeah, probably. So in any case, that's another reason why we need to be double, triple on our game.
Yes.
There are going to be fewer realtors in the business 12 months from now, a lot fewer. There's no question about that.
It's so competitive.
Yeah, it is. Newly built homes, talk about that, Sarah.
We have a lot of, everybody's seen it, particularly out in the Western region. We've had a gigantic boom in home building. And I actually read today that currently we have 1.7 million units, and this is multifamily and single family, under construction. It is the largest quantity of properties under construction at one time in history.
Yeah.
And so we look at it, and what builders started pulling back months ago, because kind of typical rule of thumb, if they get to 6 months supply, they're gonna slow down their building. And you look at, we're almost 11 months supply.
Yeah, and that's a danger zone for builders.
That's
why they're offering incentives and discounts now, right?
Yes, and so that's where, when you look at some of these markets, they're offering considerable concessions, considerable discounts. And as you look at your competition as you're listing a resale home, you got to know what's going on with those new builds in any area if they're nearby.
Because they're competitive to your existing home listings.
Yes.
And we talked about that on a team call, the importance of don't just use your competition in the resale market, use your competition in the new home market, and know that most builders around the country are now offering incentives. And those incentives in Arizona, I believe you said on a team call, are among the highest at close to 20%.
Huge.
20%.
That's a huge number.
$600,000 home, builders might offer you as much as $120,000 in perks and incentives now to buy that home. And what a dramatic shift from 6 months to a year ago when there was a wait list to get a new home. Boy, how quickly things change. So now that's inventory. Let's look at demand. Go ahead, Sarah.
So we have a number of ways that we can look at demand, and one of them are showing requests. And so this kind of takes the picture of July over the last 6 years to see where we are and where we were pre-pandemic. So while we're still ahead of where we were in 2019, we're definitely, you see that considerable decline. And July typically does see some movement, particularly in not places that are 1,000 degrees. So, when people are looking, so this is a noticeable decline.
And what's interesting is that showings are not bad. The number of showing requests are above 2017, 18, 19, and obviously in 2020 and 21 it went kind of crazy. But 158, an index of 158 is not bad. What we feel like's happening is buyers are still looking, they're just not buying at the rate they did. So the showings are still there, but buyers are more cautious, they're more resistant. Would that be a fair statement?
Absolutely. And you'll have more of an opportunity to do a repeat showing. Sometimes people want to go back and look again. In 2020 and 2021, you didn't have time to go back again.
Yeah.
So you kind of I know it doesn't have data on that, but when I bought houses in years past, I brought my parents back and we looked again. And
and that was not been true the last couple of years, but now it is.
You couldn't, and so now you have that opportunity to go back. So it could be repeat people. Repeat people.
So yeah, a lot of that could be repeat people because a showing is a showing is a showing, right? So maybe that 158 is not a big part of that is double showings, triple
Yes.
showings, same people.
Yes.
Exactly. Okay, so supply demand ratio. Talk about this, Sarah.
So this is where we always look at supply and demand, and what we ran into in 2021, we had very little supply and a ton of demand because money was so cheap. Well, things have changed, and this shows just using the same showings data and comparing it to our active inventory when, we've seen those inverses. We had more showings and fewer active listings, and so now it's the inverse, and we have fewer showings and more active listings.
And this is year to year. So this is going, what, last July?
July to
last July to this July. So if you baseline would have been in the center, but now we have 16.8% fewer showings with 26.6% more homes to look at. Okay.
It's coming at both sides.
Coming at both sides, exactly. So, and everybody, of course, in our business feels that, right?
Yes.
So purchase mortgage demand. This is interesting because demand for purchase mortgages is essentially people who have bought homes. So
Yeah.
talk about that.
So this is coming from data from the Mortgage Bankers Association, and they look at purchase mortgage applications. And, they do separate out, which is really nice for us, the refinance applications. So this is removing the refinances. And so you can see where, as the mortgage rates, which is the black line, they went down. Well, clearly those applications went up, and you can see that kind of where it crossed and went to rates are high. And so we saw a significant decline in where those applications were. And when you see such, kind of incredible movement, that's why pre-pandemic, they were a lot tighter.
Exactly. And so you can see pre-pandemic, you can see the squiggly blue lines there just before the big dip.
Yes.
The big dip just after the 2020 line was when COVID hit in
Lockdown.
March. And that was a quick dip, and then it shot back up, boom. And you can see that now we're actually below that 3.5.
Yes.
We're below the demand for mortgages, the whole baseline going back to 2018. The demand is significantly below even that. And
Yes.
obviously the lenders are feeling that big time right now.
And this is just zooming in on that.
Yeah, so purchase mortgage demand relative to rates. Talk about that.
Yes, so
Sarah.
again, this is taking that last slide and going in just in the last year. And you really see, because so much of it had to do with when the Fed was, buying the mortgage-backed securities, keeping rates low. They stopped and they actually started, selling some of the more, trying to offload from the book, their books, some of those mortgage-backed securities. You see that change. The rates going up, and it had an immediate impact on those applications.
Yeah, exactly. Obviously, rates go up and the number of applications go down, and pretty straightforward stuff. So this, to me, this is one of the key slides. It's why I watch the stock market every day, because that's a good indicator of what's in people's heads. When people don't have a lot of confidence in the economy, they sell stocks, and when they do, they buy stocks.
Exactly.
So talk about consumer sentiment, because this is something we all need to digest big time. Go ahead, Sarah.
For sure, because consumer sentiment is probably one of the biggest factors in what happens within an industry, within the economy. 24% of consumers, and this is going to be in the light blue, think it's a good time, or think it's a good time to sell. That's gone way down. And you see it was increasing and then tanks. And then, 73% of consumers think it's a bad time to buy. And so if this is what the consumers are thinking, we need to understand that as we're having the conversations with them about the benefits of home ownership.
Right.
Because those remain.
Yeah, and we're going to talk about rentals, and unfortunately for our industry, well, our industry on the sales side, not the rental side,
Yes.
Rentals are now becoming very attractive as opposed to buying. We'll talk about that. But 73% of consumers think it's a bad time to buy. That is not a statistic that we want to see. And only 24% think it's a good time to sell. And I'm sure that's a factor of two things. Number one, sellers are starting to realize the market is a lot softer, demand is not as high. And number two, they're figuring, I've got a 3% loan, why should I trade up to a 6% loan? So,
Precisely.
okay, so closed sales. So existing home sales annual, this is closings. Talk about this, Sarah.
So this is kind of showing, and I like the 20-year picture on it, and sometimes some of those numbers don't seem as substantial, but when you look at some of these movements, for a long time we were hanging out around 5 million, and in 19 was an awesome year for real estate. Mm-hmm. Things were good, sellers were making money, buyers were getting loans, it was good. And we had 5.2 million resale closings in 2019. Then you get to 21, which was record breaking for
Yep.
a lot of places. We had 6.1 million, and a lot of that is due to the rates. And we also had some population growth. It's the right time that would also help with that. And then the forecast, and that's what the F is the forecast for the end of 2022 is back down, and we're talking almost 1 million fewer resale closings
than last year.
Than last year.
And what's interesting, I want to make a comment, is of that 5.2, if we make it to 5.2, there's been a lot of that, a proportionally larger percentage of that was in the beginning of the year.
Yes.
So
Thank you
do
for saying
realize
that.
you're feeling like you're in a market that isn't 5.2 million. It's maybe 4 million, 4.5 million, a very low sale market, because we had so many sales in the early part of the year. Would that be a fair statement?
Yes. And I also want to add to this is you'll see a lot of different numbers with these forecasts. And just my own kind of opinion on this, I think the 5.2 million is probably on the high end.
Yep.
I think that we may be under 5 million,
Wow.
just given what we've seen because of the significant turn down we've seen on
And
that
how
demand.
quickly we're seeing it slow
It
down.
moves so fast that the forecasts, and I love NAR for having that confidence in
Right.
our industry, but
Right.
I just don't know if we're going to get there.
Yeah, exactly. And so total existing home sales percent change year over year.
And this
Sarah?
is why.
Yeah, so-
This is showing why I don't know that we'll get to those numbers, because you see each month we're having bigger and bigger declines.
So this is month to month, guys. Take a look at this, month to month, and this is all goes back to what, July 2021. This is a 1 year look, starting back in August of 2021. We started to have a decline in existing home sales. Now this is closing still, correct?
This
So
is all closings, and it's year over year.
It's year over year. So look at it going up, 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 and then 6%, 8.6, 14.4, and then in July, 20.2% compared to last July, correct? These are all year over year percentages,
Yes.
right?
And I've heard some preliminary numbers. Now, NAR has not released their August numbers yet, but I've heard some preliminary numbers looking at a 30% decline for August.
30% decline.
So
in August.
again,
and everybody out there watching today is feeling that,
Yes.
of course. And that's why I've said before, and I will say again, this is the time to shine. This is the time where the number of people, number of agents in this industry is going to shrink. Be assured, it has to. There's not going to be enough money, enough commissions generated in order to support the number of realtors we have. And you don't want to just be a survivor. You want to be one who prospers in this. And that's why we're showing you this. And then what we talk about constantly on the team calls, and Sarah's on so many of them, is how to take this market and to shine in a market like this, right? Okay, so existing home sales by region. This is really interesting. Talk about this, Sarah.
And this is, so the pie chart is for, all the sales that we saw in July, but then this breaks down by the different regions across the country of what we're seeing month over month and year over year in, and again, this is closed sales, talking about where that movement is. And you look at, say, the West, and that's where we're looking for sure, and that's a 30% decline year over year. So that's when we're talking about, and then maybe, and that's July.
And let's just talk about July. In the West, 9.4% month over month, sale decline, and 30.4% between last July and this July. So be clear what these numbers are.
Yes.
So that's in writing. Now in the pie chart, this is the percentage of sales in the U.S. that these regions represent. Is that correct? So the graph, the pie chart, is not what you're reading.
Right.
Yeah, so
That's
like the South, which is massive, actually composed of 44% on average of all the sales in the country, correct?
Yes.
The West 18, the Northeast 23 or 13, and the Midwest 25. And I'm going to presume if we added those up, it's about 100. It is. Okay, good. It's 100. It should be so.
And you look at like the reason the South is so big, the South is where the prices are the lowest.
Yeah.
And so that's going to make up.
So you see more sales.
Exactly.
So you see in the South, we had a 5.3% month over month decline in sales, 19.6% year over year. And I guess the Midwest did the best.
Yes.
Existing home sales declined 3.3% month to month and 14.4% year over year, which is the lowest. Both the lowest monthly decline, the lowest yearly decline.
And some of the reasons that we'll see those smaller declines in the Midwest and the Northeast is there's fewer new builds there.
Fewer new builds to compete with the
Yes,
existing home sales.
exactly.
Makes a lot of sense. Okay, sale prices. This is, if you own a home, this matters, right?
Exactly.
So go ahead.
So this is showing the median sales price kind of as we've moved, and you see the decline has started. And one of the things that's interesting is how quickly this movement's happening, because we saw, if you're comparing any time when we've had weakened demand, prices often follow a year later, 18 months later, not 2 months. And that's what our motion has seen. I expect to see that number decline again in August, and we will see expected continued declines through the end of the year.
So we've basically seen on a national basis, and that takes all regions. In the West, we've had a more significant decline.
Yes.
In some of the hotter markets. That's all
Yes.
over the news. The hot markets. Phoenix been a super hot market. Vegas, a super hot market. Boise, Idaho,
Yes.
super hot market. Those markets, because they were so hot, they come down faster. Go up faster, come down faster.
They had the biggest increases, so they're having, decreases
biggest
early.
decreases,
Exactly.
declines in prices. But we've seen, so that is what, May, July, is that what we're going to? So January, March, April, May, June, July. So that's every 2 months down there. And basically you can see we've lost, not quite 3% in value nationwide, 2.5%, 3%, 413 down to 403. Yes. And every prediction is that will continue to decline. Yes. So this is just like an incredibly important graph for listing appointments.
Yes.
It is not, time is not on your seller's side. You know that, you're showing them the local graphs, but on a national basis, it's clear the seller who sells now is going to do better than the seller who sells in 3 months or 5 months or 6 months based on every single index we're seeing. Okay, so year-over-year change, so CaseShiller, talk about that.
So what this is looking at is looking at both NAR and CaseShiller data, and they have CaseShiller is what the federal government uses. A lot of companies and businesses will look at CaseShiller. It's really, really great info. It's old. So our industry doesn't look at it because it's, we don't, it happened 3 months ago we've moved on. But when you look at it, this is what a lot of other industries are looking at. So it's good to be aware of it. And then of course we have NAR data, and this is just even showing our year-over-year appreciation rate is declining, and that was represented by those numbers we just saw on the last slide. But here's another way to illustrate that. Particularly, you're talking to somebody and they say, "Oh, prices are skyrocketing." It's like, well,
yeah, well, they'd look and they'd say, "Well, let's see, prices are still going up." What CaseShiller is saying they're going up 16 or 17%. But that's a year-over-year, and I mean, what happened is you've got very hot appreciation, let's say in the first 7 or 8 months of the year-over-year, from last year at this time to this year at this time, going up like this, then coming down like this. And if you draw that straight line, then what was 22% would drop to maybe 16%. But that is misleading if one thinks their home is still appreciating at 16 or 14 or 12. Not true. CaseShiller index tends to send a wrong message. Like right now, homes nationwide year to year are appreciating at 14.4%. Not true. In general, homes are going down in value, and it's really not representative to look at a year over year. Look at 3 months. Exactly. You want to see what's happening, look at 3 months. Okay, so.
And some rule of thumb has been based on how many sales there are in anything if you look at year over year versus month over month. Yeah. Because we know with month over month, that's what we need to be looking at. We have enough churn in the industry. There is enough turnover with the houses that we have comparables.
We do. Okay, and then percentage of properties. You guys know this, you're living this.
Yes.
Talk about price reductions here, Sarah. And I'm correct in that 2022 is the dark red.
Yes. This is, and we have, a number of years of looking at, 16, 17, 18. These were pretty standard years of, you see the seasonality with price reductions, and then you see where we started the year off, just like Greg was saying, we had such a strong beginning to the year. You see that way we were so far down, and then it has actually pushed up very quickly. We're over 40% of properties that are active are reducing their price. Normal is about 30 to 33%. And, you know, the expectation, if you get to 45%, you're kind of in a bearish market.
You're in a bearish market. And I mean, even more than a buyer's market, in a bearish market.
And for comparison, when we were around 08, we hit 50%.
50%. So we're at 40.6 and 08. At the peak, the worst in 08 was about half the sellers had to reduce their prices. And what you have to realize here is sellers are becoming aware of what the market is.
Yes.
And so it's interesting, you would think that more sellers would price their homes correctly. And I think many are trying to. I think there's a lot of realtors who are, you know, painting the correct picture.
I agree.
But sellers still can't catch up to where the market is. And that's why you see that 40%, because ultimately it's their decision, not ours, where to price the home. Rental rates. This is interesting. You know, a year ago, there were bidding wars out here in Arizona to get a rental. Bidding wars. The rental market might have been even hotter than the housing market, the resale market. Talk about this, Sarah.
And you know, incredibly low vacancy rates. It was a bloodbath. And you know,
for potential renters.
Yeah, for just
landlords are doing great, right? Yeah.
Yes. So the rents were increasing, and a lot of it is because a lot of big investors were coming in and buying across the board. We had local investors, iBuyers. We had iBuyers aren't renting, but the big corporate, you know, institutional buyers to rent. They had such a flood that now they've got all this inventory, so they're dropping their prices. It just started. Rental rates are about down 1% since the peak in July, and that's a pretty quick movement. And I know it's just a little arch at the end of that chart, but this is something that is very important, because as renters, and there's a lot of single-family rentals around.
Yeah.
That is
more
now,
single-family rentals than at any time in history, because so many homes have been purchased for rental.
For the purpose of
renting.
renting.
So that is huge competition for our industry, because these, let's say, home buyers, many first time, some even not. Last stats I saw is that you paid on average $600 less for the same home as a rental, as opposed to your mortgage payment if you bought it.
Yes.
Yeah, and of course that's the biggest part of that is not rents coming down, but interest rates going up.
Yes.
But that is one of the reasons that demand has to be dropping so much, and that is people are saying, what the heck? And again, this is not to, I don't know, be the bearer of bad news, just for all of us to understand what's in people's heads.
Yes.
And that is that a person might say, well, homes aren't really going up in value. There'll probably be more of them on the market. Maybe I'll rent. I get a nicer home for less money and don't even have to put a down payment up. And I don't have to worry about my home going down in value. So maybe I'll just wait till rates come down and things stabilize. That'd be a very normal state of mind.
Absolutely.
And that's one that we obviously need to overcome as an industry. Okay, so rental rates and home price forecasts.
This is going to where we think.
Yeah.
And this kind of grabs a lot of the major players that are making these forecasts of where we are. And even if you take the average of a lot of these across the board, you know, it's the reason we have the average of that 10%. Got to remind it, the gains were really taken early this year.
And this is this year, guys.
Yes,
and do understand, this is this year, not next year. This is not now from this till this time next year. And there was 20. That 10.3 was at one point around 20 early in the year. So that's how fast they're dropping it, which again is a good indicator that home prices across the country are dropping. Would that be fair to say?
Absolutely.
Yeah. Okay. So home price forecast. And for 2023, I will tell you that I saw, you guys could pull it up, look at Seeking Alpha and their recent analysis of Open Door. And they're basically saying that Open Door is really going to struggle as a business model, which I'll take the credit. I've been saying for how long? Since the beginning. And I believe their stock the other day was below $4. Ooh. And it was $3 and something, I believe, yesterday. So they've dropped 70% this year. This is not a criticism of the people at Open Door. This is just a business model. That is a business model that can make it in the kind of crazy economy we had before, but not in a normal economy, not in a normal housing market. So bottom line is that Seeking Alpha analysis of Open Door predicted, and I'm not saying they're right, that they predicted that, look it up, guys, that home values would go down as much as 20% between now and the end of 2023. Now, I'm not saying they're right. I'm simply saying you really hate to see people read that, you know?
Exactly. And you kind of want to make sure that there is the understanding of what are they looking at, and particularly in the markets that do have a lot of those open door properties, with some of the price changes that they're putting in, they are bringing the overall market
And
prices
they are.
down.
Open door, where you have a lot of that, they're dragging it down in Phoenix, I can tell you, that they are unloading homes like crazy.
And I want to mention, if you take a look at the average of these 6 forecasts, that's 2.5%, and you're like, okay, cool, prices are still going up slightly. But then if we're running at right now 8.3% inflation rate,
you're actually
that's
losing
actually
purchasing.
negative.
Yeah, it's actually negative, because you basically subtract 2.5% from 8.3%, and then your home, in terms of real value of the money, is actually declining at about 6%. Exactly. Okay. So, and why this is different? Go ahead.
And this is, a lot of people are, this is why creating the confidence with the consumers of what actually is happening, because there's a lot of, the sky's falling, let's, fire sale, get rid of it. No, that's not, we're not looking at a giant foreclosure crisis. We're not looking at some of the things that some of the headlines are suggesting. And it's just, look at the evidence. We have some of the lowest levels of foreclosures in history.
Yeah.
And, this kind of speaks for itself.
Yeah, you can see back 08, 09, how it peaked and how low it is now. And, a number of reasons. Number one, most people who have homes have very low interest rates. Number two, most people who have homes have a lot of equity because they got so much appreciation.
Yes.
And number three, the unemployment rate is what, 3.5%?
3.5%?
Yeah, 3.5%. So most people have jobs. So that's why this is very different than back 08, 09. Purchase mortgage demand over 25 years. You can see how it's dropped there. We talked about that earlier. 33% down from peak to peak. But look at where it is now.
Right. And so again, these are not apples to apples. You can't compare. It may feel like some of the intensity, but what's actually happening is very, very different from the boom and bust we saw in the past.
Exactly. And then again, this is all about why it's different. The length of crisis different than last time. Talk about that, Sarah.
So we actually had the slowest recovery in history from the Great Recession, when we had massive job loss. It took almost 10 years to recover the jobs that were lost during the Great Recession, where it took 2.5 for what we just went through with COVID. So it just shows how different the market and just the economy's fundamentals, where people have jobs and there are a lot of jobs available. And so it's going to enable people to make their payments and, keep their equity.
So really, my characterization on this is this will be, none of us want to see a slowdown, but there's no question we are in a slowdown, and we will continue to see a slowdown for a year or two at least, and maybe longer. But this is what I call a healthy slowdown.
Right.
A healthy slowdown. People have jobs, people have equity, people are probably most people are not going to lose their home.
Yes.
So it's going to be a slowdown. It's going to be more challenging for those of us in real estate, because we have to shine over our competition in order to prosper. But it's still a healthy slowdown, not a slowdown that I'm going to say could have been a meltdown. And then industry impact, we'll wrap it up here. Go ahead with our industry impact, Sarah.
This is what you kind of, the theme throughout the whole thing is, if you look at the increase over the last 10 years, we've had a lot more agents coming to, just joining NAR. And if you look at, and this is just through August of 22, the other numbers are the calendar years. So if we see it, just since 2019, we've had over 200,000 new NAR members. And these numbers, we're pushing 1.6 million members. And if we're going to see, so if we have 1.6 million members and we have, say, 4.8 million resale transactions this year, and the forecast for next year is even lower, it's going to be that much more competitive. And now we're looking at, it's going to be tough on our industry. We have to really shine. We have to provide the confidence to the consumers so we get to continue being in the business, because there are going to be, this is when we see a lot of people leave the
And when we say
industry.
we,
all of us.
Well, how many realtors out there? 1.6 million? There's not enough business for all of us.
There's not. And so
let's just cut to it. So if there's 5 million sales, that means there's 10 million sides. And that's presuming that next year buyer agency doesn't go away.
Right.
So this Stitzer lawsuit, I think, goes to trial in February. Yep, the Morrow lawsuit maybe later in the year. These are the two lawsuits that are basically saying sellers should not have to pay buyer agents, which would, if they prevail, that would eliminate the MLS's ability to, well, the MLS having a buyer agent co-broke field, and buyers would end up paying their agents, and how many would? I'm simply commenting, right now we have 10 million sides a year for what, 1.6 million realtors. So do the math on that. That's 4 or 5, was that 5 sides a year? Is that what that is?
Less.
Yeah, less. So really,
I mean, like 4.2 or something.
Or something like that. So, you know, and that's sides. That's not sales. That's transaction sides. So clearly, this is the time when some realtors are going to survive and prosper, and a lot of realtors aren't. And so, despite low inventory, significantly low buyer demand, combined with higher inflation, higher interest rates, higher sale prices, and lower investor homes are staying on the market for longer and selling for less. So that's kind of a summary slide, right? That's despite the low inventory, the significantly low buyer demand, combined with higher inflation, higher interest rates, higher sale prices, and lower investor returns, homes are staying in the market for longer and selling for less. So I'm going to wrap that up this way. I want you to consider that if there was ever a time to be a salesperson, this is the time to be a salesperson.
Yes.
Sellers hire us to sell their homes. They don't hire us to put their homes in MLS. They don't hire us, and this is me talking, my opinion. They do not hire us to just put their homes in MLS and see what happens. They don't hire us to put a lockbox on, let people look at it, and submit an offer whenever they happen to like it. Sellers hire us to sell their homes. Having the opportunity purchased, making every buyer feel like they're the first and only buyer to see the home. Having that coming soon rider on your signs to make that perception even more so. Using the 7-step showing process. And I trained yesterday in Idaho at a KW office up in Coeur d'Alene. Awesome. And thank you, by the way, Kevin Pickford and team. I had a blast up there. And we talked about that. We talked about setting up that 72-hour weekend, having the opportunity showing, using the 7-step showing process, using the opportunity purchase, having the coming soon rider on the sign, nothing to do with MLS, so that when buyers see it, it looks like it's not yet publicly available because you have that 72-hour weekend out there. Using counteroffer intelligence, so that when you present offers to your sellers, you can actually have a good chance of being able to tell them, here's how high the buyer will go. All these things we do, this is what will cause you to prosper in this market. This is what will get a better result for your sellers. This is selling. This is selling. This is using psychology, the kind of psychology that Fortune 500 companies use for their pristine, amazing sales staff to sell their products at maximum premium prices. And those agents in this country who learn how to sell. And I don't mean just be there. I don't mean just show up. I mean study the art of selling. And that's what we do. That's what we teach you, combined with marketing. Yes. Realtors, for the most part, and I get it, they don't know how to market. That's not a criticism. That's just a fact. Realtors are realtors. They're not Madison Avenue marketers. And so the idea of learning how to market, or at 72 sold, and I'm not doing some pitch for us, that's why we have a whole market. You were just upstairs.
Oh, it's incredible.
Like several thousand square feet of some of the best marketing people in the country, for sure, so that we can be the marketing arm for our realtors. And then our realtors can go out and use psychology to sell houses. Yes. They can shine. And it's not like we want everybody else to go out of business. That isn't really the point. We want to shine. We want to have an abundance mentality. But the bottom line is there's not going to be enough sales for everybody to shine. There it is. And so you want to be among those who do. Thank you, Sarah Perkins. You're amazing. Sarah, you for years have done this for us at 72 Sold, and I just want to personally extend a super thank you. And for all of our agents locally and around the country who have questions, need information, need graphs, you're available to all of our agents nationwide. How can they reach you, Sarah?
Well, thanks for asking.
Totally.
You can always reach me. You can call or text me anytime at 480-707-8946.